Let's get some insights in the news shaping the markets. For that, we welcome in Patrick Healey, in person, President and Chief Investment Officer, Caliber Financial Partners. Thank you for being here.
Thank you, Nicole.
And so, look, I mean, we're getting earnings, and much of the earnings, and many of which have been winners. But this name, for example, Salesforce down 21%. How did you feel about earnings season so far?
Excuse me. I think the earnings season has largely been mixed. There's been some good results, and you've seen stocks rally as a result of that. But as you pointed out today, Salesforce has taken it on the chin, and they missed pretty badly. I think some of the AI and cloud stocks have really kind of run pretty far up into earnings season, and unless they really beat and announce guidance that's really aggressive, you're seeing some of those names being taken down.
Yeah, understood. You know, while tech is down, real estate, utilities, industrials leading the way on the sectors that actually are pulling out some green. I mean, what do you do when you look at the different sectors now when you're trying to put together an investment strategy?
Yeah, it really depends on the interest rate cycle we're in, right? And the names you just pointed out are more defensive: utilities, real estate. They've largely lagged in this market cycle, but on a day where risk on is trading off, there's a sort of a flight to some of that quality and safety, and that's why you're seeing some of those names pick up. Again, it depends on interest rates. I think utilities are a much more defensive sector. Real estate, it depends on the property types and the geographies, but I think there's largely been expectation around the Fed kind of easing on interest rates, and that would be favorable for a sector like real estate.
Understood. And so in the big picture, when we think about what the Fed may or may not do, there's so many concerns about inflation sentiment when you do a lot of surveys and such. It's something that's bothering investors and folks in general. Where do you think we might be standing on the world of inflation, what the Fed may or may not do?
Yeah, so it's not just bothering investors, it's certainly bothering people when they're going to the grocery store or filling their gas tank. But from an investment standpoint, you can tell that the market is really trying to anticipate every move that the Fed is going to make. They're picking apart every piece of testimony, every interview that's done. They're combing through sort of the economic data that's coming out on CPI or PPI. Trying to front run that a little bit, and when they don't get the number that they like, that's when you see these sell-offs and these exaggerated trades. The jobs report has largely been strong, and so I think that's giving the Fed cover to keep rates higher for longer. But at some point, we're going to need to see a rate easing cycle, and I think the market will respond very favorably to that.
Understood. And overall, when we think about rate policy, do you feel like when we think about, housing, where prices are still very lofty, if we're going to be in the higher for longer category, mortgages and such, and the labor market, I mean, so far, are we seeing some slowing?
So in terms of home prices, they remain elevated largely because there's a shortage of supply in the marketplace.
Yeah.
I don't think there's nearly as much turnover as there has been when we were in an interest rate zero cycle, because it's difficult to sell a house where you have a 3% mortgage and trade into another house that has now a 7 or 8% mortgage. You can't buy the same house. Right. Or the same size house. But in terms of the jobs report, it's been mixed and choppy data. You've seen strong numbers come in, but then the next month you'll see a revision done that knocks that number back down. But unfortunately, the market's already on to the next cycle in terms of economic data, so that largely gets overlooked.
And then also, I mean, you do think going forward, you feel positive. I saw 2025 you thought would be good news for equities. You also like digital assets. Explain that.
Sure, I do. I think by the time we get into the end of the year and really the first half of 2025, we will see an easing in the interest rate cycle. That will be good for all risk assets, certainly for bonds, certainly for equities. And yes, I think digital assets have really started to enter the growing up phase in terms of the SEC has approved a couple of different spot ETFs between Bitcoin and Ethereum. I think that's largely been well received by the market. I think regulation is starting to come into place, which is much needed, and will sort of normalize that space. I think that's good for investors, and it will create more enthusiasm and fund flows into digital assets.
Yeah, understood. When you think about Bitcoin and Ethereum and things like that, is there a place for that in everyone's portfolio? Only certain people? What are your thoughts there?
I think they're starting to be now that there are vehicles to be able to put that into
Right.
portfolios. The ETF is a whole game changer in terms of opening it up to the wealth management division, where you can now put retail clients in. Institutions now have a little bit more of a pathway in terms of regulation. And so I think that will only grow. I think it's become, unfortunately, a little bit political. I think if you ask the SEC behind closed doors, they probably would have punted on approving the Ethereum ETF last week. But I think there's a lot of demand among the younger generation, and they vote their conscience. So yeah.
Patrick, great to see you. Thank you for being here live at the New York Stock Exchange. Patrick Healey of Caliber Financial Partners.